So my name is Bruce Mayer. I am a partner at a public accounting firm, and we do a lot of work with food co-ops. And then this is Brian Dahlk over here, also a CPA, and works with me on lots of different food co-ops. So our structure on this will be open, meaning jump in with questions at any time, because we're moving through so many topics. If we wait till the end, there won't be the context on the questions if you have them. And we're also not that large. We'll see if anybody else filters in. I noticed the last session you didn't update to the new format on the slides. Luckily, we have some whiz at our office with PowerPoint. Like snapped her fingers and did it. Anyway, so I'll start out with an accountant's definition of co-ops, and I'll run through a little bit of a introduction, then Brian will go, and then we'll go back and forth on a couple of other sections. But basically, that we'll go through a definition and introductions, talk about accounting for startup food co-ops, and then taxes as sort of two different important areas. We will also talk about, related to the last session, taxation on different kinds of capital that you might raise or donations. It's a question that we get a lot. The last session was really a good segue into this one, in that we get asked some of those questions about fiscal sponsorship and so on, and now we know where to send them, so that's good. But just a minute about my career. That I started out actually as the full charge bookkeeper at a little food co-op, and went back to school and got my MBA and ended up in public accounting. And we do lots of work with nonprofits at our firm, and then also we work with co-ops all over the country. And then Brian, somewhat similar in that he helped start a food co-op and was the bookkeeper at a housing co-op here in town, and then a nonprofit out in California, and then came to work for us working with co-ops. And we have a lot of fun working with co-ops from all over the country. It's interesting to pick up the phone and talk to people in California or Maine or Florida or whatever. So the definition, as in the last talk, I'd like to relate this to the co-op principles. So we're mostly in P3 here. Business owned and democratically controlled by the people who use its services and whose benefits are derived and distributed equitably on the basis of use. And that's a very short sentence that describes pretty much all of what we do, in that a co-op is for the benefit for the members, so it's not a nonprofit, because a nonprofit has to be responsive to the entire community, not just its owners. So you may think about other stakeholders and so on, but you're primarily organized for your members. And then also the patronage dividend idea is also in here, in that you're allocating the profit based on the use, which is different. Most businesses, you allocate profit based on capital. So we're doing something somewhat radical in the scheme of capitalism, but still within that general construct. And then a few things. As I mentioned, you're not a tax-exempt organization. I have had a number of folks who started up 501c6 organizations or C4s to do something that's a co-op, and typically the IRS has told them, no, that doesn't work, because you're benefiting your members and not the general public. And they got themselves into a big mess trying to file nonprofit tax returns and being rejected and so on. So there are certainly nonprofits that are related to co-ops, but they're not actually co-ops, except in the area. The one exception is that is housing for seniors and low-income people, generally student housing co-ops. They can actually be nonprofits because they have exempt groups that they're working with, but that's a relatively unusual exception and different than what we're talking about here today. And then the other thing is to make sure to talk to an attorney Most of you probably are already incorporated, but if you weren't, you want to check with somebody who knows something about co-ops. A lot of people start up as an LLC or something else, which may or may not work later on. One of the issues is that with preferred shares or other kinds of equity that you might issue, you do have state laws to follow, and your incorporation may change how you need to raise funds. For instance, in Wisconsin, if you start as a Chapter 185 co-op, you're exempt from most state regulations on securities. But if you start out as some other entity, you may either not be able to raise funds or have other constraints. So it's important to talk to somebody. So now we'll have Brian start talking about accounting, and then I'll come back in a bit to talk about taxes. And then Brian will finish up talking about taxation of capital campaigns.
So all co-ops, even brand new startups, just in the beginning phase, you do have to keep a set of books. You've got to keep recording your financial transactions. You have to do it, number one, you want to be able to provide your board of directors and your membership with good financial reports about the co-op's financial performance and financial situation, even in the startup stage. And all business entities have compliance requirements. You're going to have to file tax returns. And to file a tax return, you have to have a set of books to report on the tax returns. So even a brand new startup co-op does need to think about and actually do the accounting work that's required. When to start keeping books? You really do need to do it as soon as you have any financial transactions. And that's often synonymous with when you open a bank account and actually have money flowing into and out of a basic checking account or other bank accounts. For the very beginning stages of a startup, you don't necessarily have to have a formal accounting software package. You could get by with something like Excel or Quicken, which is a software primarily designed for personal financial reporting. For later stages, when you're really starting to get more involved in construction and then obviously the store operation, you really do need some actual professional accounting software. Such QuickBooks is the most common software for smaller co-ops, and then larger ones might graduate into other kinds of software too. And I don't think it's a bad idea for even a new startup that doesn't have many financial transactions to use an actual formal software like QuickBooks. So that's perfectly acceptable, but you could get away with something even more simple at the very beginning stages. Oops, wrong way. So we have some basic financial reporting that should be done. Going to the very basic accounting 101 concepts, the basic financial statements are the balance sheet and the income statement. Who can tell me the difference between those two? How about Audrey?
I was going to make Janae do it because she's an accounting student.
Oh, even better.
She's going to kill me. So the income statement shows your revenues and your expenses.
Good.
It tells the story of what came in and what goes out under accrual accounting. And the balance sheet is a snapshot. It's what you have minus what you owe and then what's left over.
Excellent. When I first started working for public accounting, I worked with Audrey on my very first audit, and she taught me things that day that I still remember many, many years later. Yes, that's very good. And another way I put it, when I'm giving presentations to co-op boards, is a balance sheet represents the co-op's financial situation at a point in time, and an income statement or profit and loss shows the financial performance over a given period in time. And the balance sheet is balanced by the assets. What you have should be balanced, should be equal to the liabilities, what you owe, plus the equity, what you own, is the kind of what you learn the first week of any accounting course you would take. When you are in the very beginning stages of a startup, the most significant activity is probably going to be on the balance sheet. Your activity is probably just going to be comprised of cash, which is an asset, and balanced by probably the member shares you're taking in, which is equity. And as you go forward and get more advanced in your pre-opening stage, then items on the income statement become a bit more important. And then when you're fully open and actually selling groceries and paying vendors, then the income statement and the balance sheet are pretty much equally important. So at the very beginning, the most important thing we can encourage you to do is to at least keep good track, keep good records of your cash situation. It should be pretty obvious to everyone, not just accountants, but to everyone who is working in a business, that your cash in your bank at the beginning of the period plus the cash deposited minus the cash spent equals the cash at the end. And so keeping track of this is, we'd say, please, at the bare minimum of any startup co-op, just make sure that this information is being tracked accurately. Please be doing bank reconciliations at the end of the month, so that you know what you have confidence in what your records say your cash situation actually is. And also keep good track of what the nature of the cash being deposited is and what the cash being spent is. So you can track things in specific, meaningful categories. That's very important. So the cash coming in there are a few different categories of things that it's important to keep track of. A lot of it for the very beginning stages is just going to be the member investments, which will be equity. But you might have other things too, such as sales, donations, and member fees, which are income. And you might have people lending money to the co-op, which are loans, a liability. One of the things that sometimes happens for us and drives us crazy is when we're working with a new startup co-op their very first year, and they say to us, okay, this is all the money we took in. We took in $50,000 the first year. And we say, okay, well, was the $50,000, was it all member investments, member shares, or was some of it income, was some of it loans? And they say, well, we don't really know. We don't really know exactly what people were paying us for. It's a lot better for you to keep track of these things as they're coming in, rather than having to go back and retroactively clean up a big mess. And it's a lot cheaper to do it that way than paying a professional to do it for you too. And in the startup phase, on the cash going out side of the ledger, you're probably going to have a few different categories of things that you want to make sure you're tracking your spending accurately. Here's a list of 7 common expenditures that a co-op might have. 2 of these 7 are actually not expenses. Who can determine which 2 are generally, as a general rule, would not be an expense for the co-op on this list? Yes?
Repayment of loans and transfers between accounts.
Exactly. Yes, that is exactly right. Repayment of loans is not an expense. It's just reducing the liability that you have. And transfers between accounts is just shifting assets around between different categories. So these two are not expenses. The other 5 are generally expenses in your financial records. As you get a bit more advanced and you have an actual accounting software package you're using for your later construction phase and your operation phase, you'll want to get a good solid chart of accounts for your ongoing operations. Cometrics has what we would consider to be the gold standard of a chart of accounts for a food co-op. And you can access it at cometrics.com. I'm not sure if they have the actual chart up there, but it will certainly give you information as to how to contact them to ask for that chart of accounts. And once your co-op gets large enough and wants to join National Co-op Grocers, the National Trade Association of Food Co-ops, it's going to be required to submit financial information to NCG according to the Cometrics chart of accounts. So that is a good resource, and not just for the chart of accounts, but Cometrics in general is a good resource for food co-op accounting. Most of your expenses that are, or most of your expenditures that you're paying for goods and services are going to be expenses on your financials. There are some things that you're actually going to pay for that aren't expenses, that should be capitalized on the balance sheet, capitalized as an asset, part of your property and equipment section of your balance sheet. The things you spend that are things like buying equipment or paying for leasehold improvements or paying for major repairs and renovations. Those kinds of things, when you do that, they're not expenses. When you pay them, they are capitalized as assets, and then they will get expensed in future years by this concept called depreciation. So depreciation expense will be the way those things will get expensed. It just won't happen right away. It'll happen over the estimated useful life of the asset that you're acquiring or constructing. And then we also encounter some startups that are a little bit overly ambitious in wanting to capitalize things they spend. Things like legal consulting costs, marketing, and most labor costs are actual expenses and should not be capitalized on the balance sheet. Yes, question?
Can you explain what things are depreciated and what things are amortized? How do you distinguish?
The general rule is that depreciation happens for things that are like physical, tangible things, like equipment or leasehold improvements are actual, solid things that you can see and touch. Amortization is more intangible things like spending a lot of money on computer software is something that would be amortized. Or if you, probably not too applicable for a food co-op, a startup food co-op, but if you were to purchase a patent or a trademark, those things are not, they're not actual physical things that you can, they're not tangible property. And so those would be things that would be amortized. Good question. There is an important component of the balance sheet called the equity, which, as we said before, is really what the co-op owns itself, free and clear of any external obligations or encumbrances. Equity is generally the permanent capital with no timeline for repayment. And the most common form of equity that you get as a startup is member shares. When people purchase a share to join the co-op, that is not that should not be recorded as income on the co-op, for co-op's books. That should be recorded directly on the balance sheet into the equity account. Some of the main characteristics of member share equity is that it's usually a requirement that a member purchase equity in conjunction with becoming a member. You usually have voting rights as part of a member of a co-op when you purchase your equity, purchase your member share. And there there's usually no dividend that's awarded as part of the investment for joining the co-op. Preferred shares is another form of equity that is a possibility. Preferred shares usually are not a requirement. It's usually a voluntary contribution. They're usually non-voting, and there's often the expectation that the preferred shareholders will receive a dividend when the co-op has a profitable year. So those are two main components of equity for a food co-op. Other components might be retained patronage dividends, we'll get to that a bit later, and retained earnings, which is really the sum total of all the prior year's net incomes for the co-op that have not been given back to the owners in the form of a dividend. And one additional point of emphasis we'd like to make on equity record keeping, it's really important to keep good track of people when they purchase member shares and purchase preferred shares, that you really keep good records on the members' names, addresses, amounts, etc. That's going to be very important for you in the long run, to have that information clearly maintained for future use. For preferred shares, there are quite a bit of important rules that have to be followed, and setting up preferred shares is at least as much of a legal issue as an accounting issue. You really need to work with a good attorney to consider things like if you are going to get involved in offering shares to people out of your state, if you are going to be doing shares only to members, or if non-members can purchase preferred shares as well, and you'll need a formal, official preferred shares offering document. So these are all things that are more legal matters than accounting matters, and so working with a good attorney is something that can't be overemphasized for this situation. And we can't, as good auditors, we can't let basic accounting discussion go by without making a plug for good internal controls as well. Internal controls are the processes that an organization has to safeguard its assets, to make sure that its assets are protected. You don't want to, in a nutshell, you don't want to have just one individual who's handling and overseeing all of the cash processes without any oversight or supervision or review. You want to have at least one other person reviewing what the person handling the cash is doing. One of the most common ways you would do that is to give multiple people access to the co-op's bank account or banking activities, so they can go in and check the banking transactions, the cash transactions, and make sure that there's nothing happening that does not appear to be for legitimate co-op business, legitimate co-op purposes. You want to make sure that there's nothing going on where the person handling the cash appears to be paying for personal expenditures rather than co-op expenditures. And it doesn't matter how trustworthy the person handling the book seems, you still need good internal control procedures. I don't care if you're the person volunteering to do the books and handle the cash has been someone you've known for decades and they seem like such a nice guy. No, that's not enough. You still need good internal controls. And that's a good preventive measure too. If people know that you have good internal controls, individuals are going to be far less tempted to do an email malfeasance in the first place. So now we have some tax issues that are specific to food co-op startups, and Bruce will take over and give information on this aspect.
I have a question. Before we move away from the internal controls, I'm wondering if you have any recommendations on how to encourage your board or members of your board to be more involved in that control aspect. Because I'm the treasurer for my board, but I don't think anybody's really looking at all the information that I produce for them and checking it. Like, I feel very unregulated. And I'm generating all kinds of paperwork that they could review and reports and everything, but I feel like there's kind of this lack of interest, understanding, or sense of responsibility towards scrutinizing anything. And I'm just, how do you get people to understand their role as a board member in being fiscally responsible?
One thing you could do is just remind them that right now you're helping set policies and precedents, not just for what's going on immediately around you, but for the future as well, for the future of the co-op. And even though you might be seen as someone who's very trustworthy, there will probably be other people in your role, in future years that might not have your honesty and integrity. And so it's very important to have the policies in place right now for future people in those roles. That's one thing that might be able to spark them to think about that in a different light. Kevin.
So part of that is you're part of creating a culture of accountability within the cooperative. So things like, are there monthly or quarterly or whatever an appropriate period is, are financial statements presented at formal board meetings, and is there a culture that says we all need to look at these and at some level understand them, and if we don't understand them, are we creating access to education about so that they aren't as intimidating? Because a lot of folks I find are intimidated by financial statements, and at a certain point when you become less intimidated or more comfortable, they actually can create insight into your business that's useful from a, not just how do we take care of a problem, but how do we prevent the next one. So it's that creating
and
a
I'm
culture.
feeling like I'm not only relied on to provide the information, but I'm also relied on to provide the insight and the analysis and, tell them what it tells us. And I'm looking for more participation on that side.
Audrey?
One of the things I've seen help is, it's kind of in the bucket of board secession, but it's to get the officers to write down what they do each month. And so for your president or whoever is the designated person that's going to be the check on you, to write down that they are logging in to the bank account and looking at it each month. So that it's that write it down for the next person. So it's just the very beginnings of a board policy book or something, but that they're writing down that this is the responsibility of the president is to log, and I'm like, it takes you 2 minutes and you can do it in your pajamas, right? Like, it's not, but that they check off that each month they're logging in, they're, like a checklist of this is what the president has done each month, like, met with the treasurer to review or whatever, or your executive committee or however you want to do it. The whole board probably is not going to do it, but if you can get your officers to do it, and to maybe meet beforehand, or just to like log in and say, yes, you know, I logged in and I looked at the bank, but it's the writing it down as a responsibility of that position. I've seen help create more accountability in volunteer boards.
Yeah, that's really good, and I'll throw in some, we're actually on time, we're slightly earlier than our plan, so that's good. And encourage people to ask questions. Taxes tend to generate a few more questions than accounting, but I'll tell a story about a little startup co-op that is just a few $1 million in sales, and they've had at least 3 frauds, like money frauds, over the course of their existence. The first one was that right after they started, they had a bookkeeper and nobody was checking on the bookkeeper, that nobody was looking at the bank reconciliations and so on. The person was writing checks to themselves. And nobody knew because nobody ever looked at the bank, and it was not large enough until it became large enough. The one good thing, most people who do frauds eventually get bold enough that they do something that gets noticed, but it's unfortunate. The second one was they had a CPA on the board who also had like a bookkeeping service, so he was an independent CPA with a couple of employees. And they needed somebody to take care of the books, and he started taking care of the books for them, and ended up stealing money from them because nobody was checking on him. You know, he had folks you know, doing the bank recs, taking care of reconciling deposits and all that stuff. And this was back in 2007-8 during the recession, and he had some real estate investments that were underwater and started borrowing money from the co-op and never paid it back, ended up going to court. So that was like within a few years of each other. And then a few years later, the general manager's wife was keeping the books, and he trusted her, and nobody else was looking at it because they were grocery professionals, came into this co-op with lots of experience, and oh, they know what they're doing. She was stealing money. They both ended up losing their jobs at the co-op. So luckily this co-op survived, but especially after the CPA was stealing the money, I was talking to the treasurer, and she's like, you know, it just seemed wrong, and I was asking about it, and he kind of pushed back and said, you know, no, you don't need to check, you know, we're professionals. And so that's it's an uncomfortable situation, but you know, kind of like an abusive relationship, you gotta deal with it. So anyway, maybe you can tell those stories, and you know, luckily that co-op's still around.
One quick question on accounting. I'm assuming all this information is good to get us to file the taxes. However, how do you prepare for an audit?
Well, that's probably a whole other session. I think Audrey's talking about that at CCMA if you're going to South Dakota. But an audit is a lot of checking on the documentation for your financial statements. And so it's not something that you would do unless you have to, until you get larger. When you get large enough, you have a pretty big asset of the community and your members that you maybe want to have an audit at least now and then to check on things to make sure that things are stated correctly. When you're smaller, you'd only do it if you had, for instance, a grant that said, we'll only give you this $200,000 if you go out and get an audit. But getting ready for one is a lot of work, and so it's helpful to have you know, a professional bookkeeper or somebody who's been through an audit because they have to get together, you know, your bank reconciliations and make sure all your loan documents are organized and things like that.
It does seem like there's quite a few grants out there that do require.
It's true, and we've certainly audited entities where there's really nothing there, but the professional standards for audits, you know, it's no longer paper, but if it was paper, it would be like, you know, a huge stack of things that we have to do just to be able to sign off on an audit, so they're not cheap.
Right.
You're talking about it.
It is quite expensive.
Yeah,
like
at least
with another
$5,000.
organization with we'll do like an updated version of the audit, and like not a full audit, and that'll suffice.
Yeah, well, right, there can be other things that will satisfy them. Oftentimes they'll ask for an audit because they're used to dealing with nonprofits, and in the nonprofit world, audit is pretty well required if you deal with enough money. So. Okay. So taxation. So you've been keeping track of the books and hopefully have some kind of records. Your organization needs to report that to the IRS and your local taxing authorities. There's a few different kinds of taxes, but one of the first things you have to do to get ready to do that is when you incorporate, you need to get an employer identification number from the IRS. So that's what you need for eventually when you pay payroll and if you have contractors and all kinds of things like that. And you need it for your income taxes. So one thing that gets people confused is on the application for that employer identification number, which you can do all online at irs.gov, is that there isn't really a box for a non-agricultural co-op, so there's not any obvious place to check a box. And so you just check one for a regular corporation, and that's a good thing to know is that when you're a co-op corporation, you're basically a subset of the generic corporation, which in the tax world is called a C corporation. And then the other thing that you need to do when you choose this EIN is that you're telling the IRS when your year end is going to be. Most new co-ops choose December, just it's sort of the natural way that we think. The largest number of large co-ops, somebody like Willie Street Co-op here in town, have a June year end. It seems to work better in the grocery world as far as your slowest time of year is often in the summer. And so after June 30th, you have time to get your books closed up so that you can do your taxes and if you do an audit. But whatever year end it is, maybe in your bylaws, you have to say that to the IRS, and then they will then set their clock ticking on when they expect you to file a tax return. And that tax return for a co-op is an 1120C, which is a special form which was in the subset of all corporations, and those all corporations, your normal big entity will be an 1120. So this is a specialized form within that. But just so you know which one it is that you're looking at. So there's a lot of different kinds of taxes, if you don't know already before you get involved in your co-op. So you have payroll service or payroll taxes, particularly is an important one, and it's probably the one that gets regulated and penalized the most. There are various kinds of taxes where if you're late or don't do something, maybe there's not much of a penalty, but payroll taxes, they will come after you. And so you want to make sure you're doing it right. So we always recommend people use a payroll service. Even if you just have one employee, there's just too many rules and things to do. And there's all kinds of things that are just mentioned here. If you have benefits and so on, generally in a startup situation, you don't have that. One of the other things in taxation that you need to keep track of is that if you have contractors, a lot of times you will be paying somebody for a market study or something, and they may be an independent person or some other kind of consulting, marketing, whatever. You do need to keep track of that, and if you pay them $600 or more, you're required to give them a 1099. They changed that from 1099 miscellaneous. Now it's called a 1099 NEC, non-employee compensation, to split it out from other kinds of reporting. So when you start doing business with somebody that you may or you will pay over $600 or more, you need to get a Form W-9 from them, which collects the information you need to do that reporting form. There are penalties for not doing 1099, so it's something you want to make sure you do. And then if you do have bonds or member loans or preferred shares, you may eventually need to get 1099 to people if you pay them interest or dividends. Preferred shares, you pay dividends. On bonds and loans, you pay interest. So two different forms. But you'll need a W-9 for people there too, because it is something that they have to report on their own taxes. So you want to make sure you're getting people's social security numbers or employer identification numbers. it's always a pain to go back later and people won't respond and this and that, but if it's with your initial offering documents and it all gets done at once, you'll have it. And then another one that you'll often deal with even before you start the co-op is sales tax. And this is all a very state-dependent rule. But if you start selling T-shirts or you go to a farmer's market and you sell things, depending on what your state is, the stuff you're selling might well be food. There are exceptions for very small amounts, but you'll probably go over that, so you want to make sure that you know that you've registered to do that. Sales tax is another area where it's not as tight as payroll tax because they don't really know if you're selling something or not, but you know, sales tax penalties can be pretty steep. So you want to make sure that you're figuring that out, and of course once you have an actual store, sales tax is a huge issue.
I have kind of a specific question. So for most co-ops, there's not a lot of grants, and I know Kevin just discussed kind of that pass-through function. And really the grants that are out there for co-ops are usually not that financially consequential, you know, it's like a small amount for feasibility. But the Healthy Food Finance Initiative goes up to $200,000. So does the co-op have to pay tax on that? And would that be like a 15% corporate tax?
Yeah, we're going to talk about that in more depth a little bit later, but just to say, because it doesn't hurt to repeat a few times, yeah, the IRS does not really recognize that a corporation can receive a charitable donation, not just in the sense that the donor can't deduct it, but in the sense that the co-op has to report it as income. And it's an area that we've looked at. You know, I can't say that, you know, that we've looked in every corner of the tax code, but we've read a number of cases where individuals gave money to corporations and the courts, the IRS and then the courts said, yeah, that's really taxable. And there were a few instances that are much like a co-op where somebody was, say, shopping at a store and the store was struggling and they did, you know, I guess the analog equivalent of a GoFundMe campaign, and they gave money to this business and, you know, said that it was a charitable donation. The recipient business didn't claim it as taxable, and the IRS said, no, it really is taxable. And the courts basically said there isn't really any charitable intent. If you're a customer of a store, you're giving this money to keep that store in operation for your own personal benefit. So not a contribution.
Would that be taxed, sorry? Would that be taxed at the corporate rate then?
Yes, and right now that federal rate is 21%, and then whatever your state rate is. And the other thing to remember though is if you get a grant to pay for, say, a marketing study, whoops, didn't need to do that. If you get a grant to pay for a marketing study, you'll probably spend it on that marketing study, so the net result is zero. And so there's no actual tax if you don't have net income on it. So something to remember. Do you have a question?
Yeah, yesterday we learned about the new markets tax credits, and Pastor Flynn kind of had a love-hate relationship with this, but he didn't say why it was so cumbersome. He just said it was cumbersome. But what exactly are they, and why do they have to be so cumbersome? Because they sound beneficial.
Yeah, we have worked with a fair number of co-ops. Brian is somewhat of an expert in new market tax credit accounting on the recipient taxation end. Again, back in the analog world, we had some nonprofits that applied for new market tax credits, you know, many years ago, and you end up with a whole shelf of legal documents. And it's basically to comply with all of the different federal regulations. The good thing, or the reason that the project exists, is that investors get a very large tax credit on their investment. And the benefit to the co-op is that oftentimes a fairly large portion of the loan, the new market tax credit loan, gets forgiven. And so you get you know, very low cost money, but you have to jump through lots of hoops. Typically you're having to create a certain number of jobs, things like that. As part of it. You know, why it has to be that way, I don't know, but it is. And so you end up paying attorney fees that are, you know, in the multiple tens of thousands of dollars to put that whole thing together. Sure.
Well, one other thing about new market tax credits that we've encountered for food co-ops is that for whatever reason, the food co-op itself has not been eligible to receive the credits directly. All of them have had to set up some subsidiary organization to actually accept the credits. And then the co-op is a majority owner of a subsidiary, but then you have a minority owner too, and that just makes the accounting and taxes a lot more complicated during the time that the credit is in existence. So every time I am working with a client that is a new market tax credit, even if I've worked with them for a few years, I have to spend a bunch of time just re-familiarizing myself with that whole arrangement and how everything was set up. It can be very complicated with the flow of the funds and the ownership percentages and how it all goes through to the different entities. So that's another reason why it's kind of a love-hate relationship that you might have with it.
Yeah. So another kind of tax is property tax. Not a big deal. You typically don't own much. Maybe a startup might own a freezer or something like that, but not a big deal until you actually have a store. And then as far as income tax goes, you will have to report income taxes. So I had mentioned before, Form 1120C, and a grocery store is always going to be accrual basis because you're going to have inventory and payables and things like that. So you want to make sure that you don't start off cash basis because then you have to go through a couple of hoops to get back to accrual basis later. And then one nice thing with corporate income taxes at the federal level is that if you don't owe any tax, there's actually no late penalty. So that is a big difference between payroll, sales, and other kinds of taxes, in that if you don't file, you get in trouble. So that's nice at the federal level. And then, as I mentioned before, the rate 21% on any profits. The states are all over the map on this. Typically in a state, you'll also file their corporate income tax form if they have one. There's a few states, like Wisconsin, that does have a corporate income tax but doesn't tax its co-ops. So you have to be a little bit familiar with what's going on in your state. But for most states, you will be taxed. And I list a number of states that have minimum taxes. I think California is probably the largest at $800, and then they go down to, I think, maybe $50 in Arizona, and so on. But some of them are based on sales. Some of them are just a flat fee for being in existence in that state. But you have to pay attention to that, and those states typically will have a late penalty because they want to get your fee.
Our EIN statement from the IRS says to file the 1120 based on our corporation status. Can I file the 1120C?
Yes.
Okay.
This is sort of a whole nother little area. But basically, there is no way to check a box to tell the IRS you're going to file the 1120C. You just have to file it. And so typically what we do the first year that we file one of those is to attach the bylaws and a little statement that says, we qualify to file the Form 1120C because we're operating as a co-op. Especially if you do have cooperative in your name, typically the IRS will just accept the form and move on, but sometimes they don't, and then you have to go back and forth with the IRS to say, yes, I'm really a co-op. It's a downside. One of the downsides of being a co-op compared to other entities, unfortunately. And then a question comes up about when you should be starting to file. Typically, you should start the clock running on filing the first time from the day you incorporate. Depending on the state, I know that New York State and California in particular, but other states as well, if you've incorporated in their state, your first tax return had better be from that date forward, and you can't just say, well, we incorporated, but we didn't have any activity at all. They still want a tax return with zeros on it. So you want to do that, and if you don't file, then they will typically penalize you somehow. Luckily not large, because the dollar amounts aren't large at that point. And then your initial tax due date is 3.5 months, so 3 months plus a half after your year end. So if you're a December year end, that's April 15th. There's an exception for June year ends that you'd have to pay attention to, but basically it's 3 months plus a half, and you can file an extension at that point for another 6 months, so you don't actually have to ultimately file that December 31st, 2021 tax return until October 15th of 2022. So you do have plenty of time, but you have to stay aware of what's going on. And just to mention, the board is responsible for filing. I haven't seen boards get into big trouble over income taxes, unlike payroll taxes where you can get in big trouble. But the board does ultimately need to know that does get filed.
What's the exception for the 6/30 year end?
The filing there is 2.5 months after year end.
Okay.
So it's September 15th.
Okay.
That has to do with the federal fiscal year of September 30th, and they want your taxes to be paid before their fiscal year ends. So, just one more little craziness in the tax code. Let's see. So we already talked a little bit about the donations. You can accept them, but they will be taxable. Up until the new tax law that came in about 2018, grants to buy real estate could be tax-free, but now they are not. They're explicitly not. So if you have a government that, say, gives you a piece of land that you're going to build your co-op on, the value of that land is taxable income at the time that it gets granted to you. So an unfortunate wrinkle in the tax code, but and as Brian mentioned, you need to know when somebody gives you money, if it's equity, a fee, a loan, because I have had those conversations that Brian mentioned, like, did those people, were they giving you a membership fee, or were they giving you a loan, or was that member investment? And people often don't know, and they're like, let me get back to you. So a question that does have to be answered eventually. And that's important to note, if somebody is paying a membership fee, that again is taxable income, and in some states it may even be sales taxable. If you have an annual fee, kind of like a admission to a movie or something like that, I suppose. And then just a note,
Can I ask
not.
a question on
Yes.
that? Because I've seen this come up a couple of times. So I've seen members that give their equity and then they give more than their equity.
Mm-hmm.
And so, but they're saying, I'm just paying you extra equity. How do y'all feel about that?
Well, one of the things that I often say, haven't said yet in this presentation, is you need to go back to your bylaws and see, because there are definitely bylaws that allow you, they'll say, a member can buy, X shares. They're required to have like 1 share to be a member, but if they want to buy more, they can. Or you can put it into additional paid-in capital, which is basically you paid more than the minimum amount for equity. But you want to make sure that your bylaws allow that. And then that you sort of have an understanding about what's going to happen if that person leaves the co-op. Are you going to pay them back that money, in which case it could well be equity. If it's really more of a donation, then it might be good to figure that out ahead of time. But yeah, we definitely have co-ops where people have put in more than the $200 or whatever, and it's still called member equity. It just doesn't give them any voting rights. Is probably the main thing to know.
What we've done is, if they're just giving a donation, we assume that anything over our share amount is a donation.
Mm-hmm.
But if they give the donation specifically to be used towards subsidizing the purchase of a share for somebody else, which is something that we've done and we've advertised, we're accounting for that as equity, but in a different category. And then when we get one of these owners where we're subsidizing their ownership share fee, we're using the money from that donation equity account towards that.
Yeah, as you're, I think implying, at least to me, that could get a little complicated, but yeah, that's certainly a legitimate thing to do, that somebody could, it's sort of like a loan fund where somebody says, I'll give you $1,000, but you have to lend it out, and when they pay you back, you have to lend it out again, and so it's never really going to be income because it's always obligated.
Yeah, we've tried to keep it classified as equity from the start.
Yeah, no, and that makes sense, and I think the only question you have to work out then is, if the subsidized member leaves the co-op, do they get that money, or does it go back into a pool to subsidize somebody else? So something to think about anyway.
So you basically created a separate account for that altogether, keep it separate.
Yeah, no, that would make sense to just keep it separate and always, revolving. One thing to mention is that a loss 1 year in year one will offset most of any income you have in year two, but it won't offset all of it under the new tax law. So if you have a profit in your co-op 1 year for whatever reason, you will end up paying at least some amount of tax on it. So it's something to be aware of, that even if you had a $1 million loss in 2020, if you had a profit in 2021 of $1,000, you'll still end up paying a little bit of income tax. Under the rules prior to 2021, or 2018 anyway, those losses could fully offset current year income, but they don't anymore. And most states have adopted that as well.
I'm thinking about something that was mentioned earlier about receiving a grant, and then, like, if you use the grant to pay for a consultant, that would essentially balance it out. Is there anything special we should be doing in either our accounting or just in communication with our accountant if we are paying for the service in one fiscal year and then getting the grant reimbursement in the following year?
Yeah, because I had recommended earlier that you be accrual basis, you can defer things from 1 year to the next. So we run into this reasonably often with co-ops where they will get a foundation grant for $100,000 and the foundation just sends them the check up front, but they don't actually spend it all until the next year. So there is something called deferred revenue where you can call that a liability at the end of your year when you haven't spent it. So you got the $100,000, you've only spent $20,000 of it, you have $80,000 to carry over to the next year. You can reclassify that from grant income into deferred revenue, which is a liability, carry it to the next year. So yes, you'd want to tell your accountant that you have that potential to defer that and not pay tax on it, because you don't want to pay tax on that $80,000 and then you still have to spend the whole $80,000 the next year. So.
The scenario you were talking about is that if you're cut a check from the beginning and you have it sitting there, what if you're, like in our case, we have to request reimbursement after the fact. So we've, in theory, received the grant, but we haven't received any cash.
Right. In that case, I think you would call it an account receivable or grant receivable because you've done enough to earn the grant money, you just haven't gotten the money yet. So again, on the accrual basis, you could claim that as income back in the year that you spent the money. So, yep. And then there's something about meals and entertainment, and there's all kinds of odd things in the tax law that you don't need to worry about now. And then Brian is going to talk about capital campaigns and some of the taxation, which we've already gone over, but again, go over in a little more detail and certainly ask any questions as you come along here.
Okay, so capital campaigns, just as kind of a refresher, they're a way to get money for the co-op before you actually start selling groceries and earning money on your normal course of business operations. Or even if you're already open and selling groceries, you still might want to raise extra money to do some specific projects. So ways the co-op can get money are loans, member shares, preferred shares, donations. Let's kind of review. In all these situations, the co-op is going to be getting cash. So if it has a capital campaign and it's getting loans, what kind of account are the loans gonna be recorded as? On the balance sheet?
Liability.
Liability, good. What about member shares? Equity. What about preferred shares?
Equity.
Equity. And where do donations go on the financials?
Profit loss.
Yes, income statement, good. Or profit or loss, either one. So you can do a member loan campaign, in which members provide money to the co-op with the expectation that they will get repaid at some point and that they will earn interest on the loan. The interest that is earned by the members does have to be reported to the members in the form of a 1099 INT in January of every year for the prior calendar year. The interest is tax deductible to the co-op, and it is also taxable income to the recipient. Your basic member shares, which are, as we said before, just the members contributing money in order to join the co-op and become a member of the co-op. This is, even if you don't call it a capital campaign, it's the most common way for startup co-ops to get an initial influx of cash. And just to reiterate that if it is an actual member share, people pay money to join the co-op with the theoretical possibility that they might get that share back in the future with the co-op's consent. That is recorded as equity and it's not taxable. If you're paying a member fee to the co-op, which is not, something that's, you're not paying to join, but you're just paying a required fee, that's for which there's no possibility of getting that money back, then that is income to the co-op and not equity. And preferred shares, once again, these are usually not required. They don't have voting rights, and there's the expectation of a dividend when the co-op has a profitable year. Those dividends need to be reported once again by January 31st for the prior calendar year under a 1099 div form. And like any corporate dividends, they are not tax deductible to the co-op, but they are taxable to the recipient. Question?
Yeah, under the voting laws, now can we amend that in the bylaws? A lot of times so we're asking for $10,000 in stock and we're gonna charge them $200 for a membership so they can vote on that. Can you add that into that share? Should bylaws, anyone that invests over the amount of the membership, say, automatically has one vote?
I think I don't think it's explicitly prohibited that you do that. But I think that's probably a bit more of a legal question, so clear it with your attorney. But as far as I know, there's nothing in the rules that absolutely prohibit that kind of arrangement. And once again, the co-op can also receive just general donations, which are generally taxable. If a member decides to donate something of actual tangible value, a piece of equipment, or maybe donate to real estate for the co-op, that is taxable to the co-op at the fair market value. So even if the member says, I have an excellent working cooler that I'll sell to you for $10, and the co-op pays $10 for it, the co-op is not taxed at that $10 fee they paid. They're taxed at the $5,000 value that the piece of equipment is actually worth. Similarly, if you happen to have a member who owns a piece of real estate for the co-op to have its site start up in, all startups should be so lucky to have that be the case, but if, let's say hypothetically that that's the case, if they donate it to the co-op or sell it to the co-op at a discounted value, the co-op still needs to record the amount for tax purposes at the fair market value of the asset, not the discounted amount it was paid or zero if it was a complete donation. If a co-op is really interested, there are some ways to structure the donation so that it can defer taxes on that donation for a number of years, perhaps a really long time, but those are pretty complicated mechanisms that are beyond the scope of this presentation. And the good old patronage dividend, one of the most wonderful financial aspects of a co-op itself. Startup co-ops are almost certainly not going to be able to issue patronage dividends during the startup phases. There's just not money to be made as a startup. But this is a very good marketing material to be able to tell prospective members that once the co-op gets up and running and becomes profitable, the member owners can receive potentially a portion of the co-op's net income back to them in the form of a patronage dividend. And as I said before, most corporate dividends are not tax deductible to the corporation, and they are taxable to the recipient. The patronage dividend is a wonderful aspect of a food co-op that is totally separate from that general rule. A qualified patronage dividend, if it's done properly, is tax deductible to the co-op, and to the recipients, it is not taxable income to them. So once a co-op becomes profitable, this is one of the most wonderful things financially about the operation. Kevin?
That's restricted to consumer-owned co-ops.
Yes,
right?
we'll get to that in a little bit, but the tax deductibility is for all co-ops, but the lack of taxable income to the recipient is for food co-ops and a few other co-ops more narrowly than the co-op sector in general. So a patronage dividend is, number one, it is something that you generally can't give the full amount of the co-op's net income all back to its members. It has to be based on the amount of proceeds that were generated by the members themselves. And food co-ops don't just sell to members. You know, anyone off the street can walk in and buy, purchase groceries from a food co-op. So for example, if a food co-op has a $100,000 net income at the end of the year, and it wants to do a patronage dividend, and 70% of its sales came from members and 30% came from non-members, it would be just 70% of that $100,000, or $70,000. That could be the maximum amount of the dividend. Another thing to keep in mind is that you don't have to give the full amount of the dividend in cash right away to the members. You can retain up to 80% of the dividend and pay it out in some future undetermined year. And nonetheless, the full amount, including the retained portion, is still tax deductible to the co-op. So if a food co-op has a good year, it has a positive net income, it usually will have three decisions to make. Number one, should we do a patronage dividend? Should we declare a dividend? Number two, how much? Should we declare just a little bit or up to the maximum amount based on the percentage of sales done to the members? And number three, of the dividend we're going to declare, how much of it should be in cash that we pay to the members, either with a check or, you know, just recording something in the POS system so that members can, you know, get that credited at the checkout line, and how much of it should be retained and paid out in some future year to be determined. And those questions are one of the most Of all the things co-op boards of directors can bicker about, this is one of the most fun things, is about the patronage dividend. And as Kevin mentioned, the fact that the patronage dividends are not taxable to the recipients is restricted for co-ops that have, in which the members are receiving goods for personal consumption, such as a food co-op. So the first year that a co-op does a patronage dividend, it needs to file a very simple form with the IRS, the Form 3941, which gets exemption from having to fill out any 1099s on the dividends it's sending out. It's a very easy form. It just asks you to assert that at least 85% of your revenue came from sales of goods for personal consumption, which food co-ops can always meet. And so it just takes 10 minutes to fill out the form, send it to the IRS always approves it, and then you don't have to fill out the form every year going forward. It's a lifetime exemption, as long as you keep meeting the 85% rule every year. Question?
What was the number on that form again?
The Form 3941. Okay, any other questions?
Yeah, and just, there was a link on that last slide, I think you have access to these, that is a patronage dividend primer. So when you get to that point in your co-op, that has a number of articles. It's a few years old, but the principles still apply. And also, speaking a little bit back to what we talked about with internal controls for co-ops, there is a series of articles that were in the Cooperative Grocer back when it was being published that are on our website or on theirs about how to do the accounting and internal controls in a food co-op. So yeah, if you need to go off to lunch, please do. We don't want to stand in your way.
85% has to be for personal consumption. What would be an example of something in that 15% that would not be for personal consumption that a food co-op might sell?
Maybe nothing. It might be 100%.
Well, is a broom personal consumption?
I would say so, yeah.
Okay.
Well, it's not necessarily like to consume, like to eat, but to consume, to use.
To use by a consumer. Okay.
Yeah.
Yeah, the issue there is partly that your members are mostly individuals. If you have a daycare that is also a member, let's say a for-profit daycare, they're buying things at your co-op and deducting them on their tax returns. So when they get a patronage dividend, that's actually going to be taxable income to them. But as an individual, I go in there and buy some hummus. I'm not deducting that hummus on my tax return. So when I get 2 cents back on that hummus purchase, it's not taxable income to me. So that's kind of the concept. Anyway, thank you, everybody.